Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. We are going to discuss Cost Accounting Module 4. So let us start. So Module 4 is the continuation of Module 3. Here, costing and control of materials. So today we will learn periodic inventory system and perpetual inventory system and inventory planning. Before that, look here a few formulas regarding materials. Record level. So what is record level? It presents the level of a stock of which fresh quantity of material should be purchased. Reorder level. What is reorder level? Reorder level is represented that level of a stock of which fresh quantity of material should be purchased. The purchased quantity will be economic order quantity. So reorder level equal to maximum use multiply by maximum lead time. Or we can calculate minimum level plus average age multiplied by average lead time. Minimum stock level. It represents minimum quantity of a stock which should be maintained by organization. So minimum level equal to record level. So minimum level equal to reorder level minus average age multiplied by average lead time. Maximum stock level. It represents maximum quantity of a stock which should be maintained by organization. Maximum level equal to reorder level plus reordered quantity minus minimum uses multiplied by minimum lead time. Average level. So maximum level plus minimum level divided by 2, or we can find out minimum level plus half of record level. Danger level, or also call it safety stock level. Minimum uses multiplied by minimum lead time. Or average wages multiplied by average lead time, or average use multiplied by lead time for emergency purchase is the danger level. And finally, EOQ, economic order quantity. Here, look, economic order quantity is represented the quantity of material which should be purchased each time. The formula is that. So associated cost mean buying cost per annum plus carrying cost per annum. Under EOQ, buying cost equal to carrying cost. Buying cost, we'll find out average inventory multiplied by carrying cost per unit per annum carrying cost percentage, or average inventory multiplied by carrying cost per order per annum. Okay, the average inventory also you can find it UQ divided by 2, and buying cost means number of order multiplied by ordering cost. Number of order, annual demand divided by UQ. Inventory turnover ratio, material consumed divided by average inventory. Inventory turnover period 365, that means 1 year, divided by inventory turnover ratio. Safety stock we'll find through annual demand divided by 360 multiplied by maximum lead time minus average lead time. Total inventory cost, ordering cost plus carrying cost of inventory plus purchase cost. Input output ratio, we'll find out quantity of input of material to production divided by standard material cost, content of actual output. So one thing, high inventory turnover ratio indicate that the material in the caution is first moving. Low inventory turnover ratio indicate that over investment and locking of the working capital in investment. Now to ABC analysis, it is the Perpetual analysis. Is one kind of inventory control mechanism. Here, all inventory is categorized 3 types, A, B, C. A is the item or goods whose annual consumption value is highest. B, this item indicate that medium consumption value is medium. And C, it is the lowest price and value is lowest, but quantity is high. Look, A, important material, generally number of item is 10%, but value 70%. B, 20-20. C, unimportant but useful. 70% quantity plus value is 10%. So, in the purpose of material control, if A category item control properly, then the inventory control would be effective and efficient. So these are the categories. Look here. Material received as replacement from supplier is treated as the fresh supply. And if any material is returned from department after issue, it has to be first dispersed in the next issue of material. Loss of book balance of a stock and actual is to the transfer to inventory adjustment account, and from there, if the loss is normal, it is transferred to the overhead control account. If the abnormal is transferred to costing profit and loss account. So we know CIF meaning CIF, cost, insurance and flight. This consignment in including the prepaid insurance and freight. FOB, fresh on board. Material moving by sea, insurance premium is not paid. FOR, free on rail. Insurance and freight is not borne by the supplier, but paid by the company or purchaser. For each receipt of goods receipt notes. For each issue of goods, material requisition notes or material issue note. Accounting treatment Normal wastage, if should be distributed over goods output increasing per unit cost. Distributed over goods output increasing per unit cost. Then abnormal wastage, it will be charged to costing profit and loss account. Sales value of a scrap is credited to costing profit and loss account and abnormal gain. Sale proceed of the scrap can be deducted from material cost or factory overhead cost. Sale proceeds of a scrap may be credited to the particular job. Normal defectives, cost of rectification of defective should be charged to a specific. Abnormal defective, this should be charged to the costing profit and loss account. Cost of normal supplies is to borne by the goods units. Abnormal, it can charge to costing profit and loss account. So it is the accounting treatment. And now periodic inventory and perpetual inventory. Inventory accounting, we know two types, perpetual and periodic. Periodic inventory is a method within any inventory sold by physical computed in the accounting period, deducted from the beginning inventory plus inventory purchase and the difference moved to the cost of goods sold account. Okay, so inventory account and cost of goods sold are a non-extended unit, the physical count. Purchase account is used to record purchase. Purchase return used to the purchase return account. Cost of goods sold. So this means that periodical system and perpetual system. Perpetual inventory is the continuous calculation of inventory. Look here. In the perpetual, inventory purchase, record purchase. So here, look, in the perpetual, inventory purchased, record purchase of inventory, item sold, record revenue and compute cost of goods sold. Year end, no entry. But periodic, inventory purchased, record purchase inventory, item sold, record inventory only. End of the year, compute cost of goods sold. So there is some difference between periodic and perpetual inventory system. Periodic inventory accounting and cost of goods sold are not existent until the physical count at the end of the year. But perpetual inventory system, account and the balance cost of goods sold and inventory account exist all the time. Purchase account is used to record purchases in the periodic, but no individual purchase account but the purchase of the account is the inventory account only in the perpetual. And look here, purchase of inventory, that means purchase accounts payable is periodic, but perpetual inventory account debit, accounts payable credit. Sales, then periodic accounts receivable debit, sale credit. But periodic accounts receivable sale is the same. But perpetual, cost of goods sold, debit, inventory credit. And the year end, only periodic, not perpetual, ending inventory after counted. Debit, cost of goods sold debit, purchase net credit, beginning inventory balance credit. So it's the basic difference between periodic and perpetual. And inventory planning, the process of determining of optimum quantity of timing inventory for the purpose of aligning with the sale and production capacity. So look here, forecasting should be accurate. Supply, demand, purchase order, inventory planning, sales order. The inventory planning, they test the number of supply chain component and include all the decision-making responsibilities associated with the custom, and develop the inventory, which can include raw material, work in progress, and finished goods. So planning, inventory planning is vital for cost control. The cost of poor inventory planning. If the planning, inventory planning, not up to the mark or not efficient, then excess inventory and obsolescence, some cost, inventory shortage or out of stock, operation would be hampered, etc. So here, one example, Neem Limited used the actual production costing sheet system. It reported the following amount: raw material, indirect material use, direct material use, direct labor use, indirect labor used, beginning work in progress, ending work in progress, selling administrative expenses, other manufacturing overhead, beginning finished goods, ending finished goods inventory. We have to calculate the cost of goods manufactured and cost of goods sold. So let's start. Cost of goods manufactured, cost of direct materials, this one, 70,000. That means it is the purchase 72, but he used 70,000. Cost of direct labor use, 66,000, this 66,000. Cost of overhead, look, cost of overhead 18,400 and 7,000. This 4, this 7, and this 18. So total 29,000. So total manufacturing cost comes 65,000. At beginning work in progress 21,000. This one, less work in progress, ending, this 16,000. Then get cost of goods manufactured 1,70,000. So okay, and cost of goods sold, beginning finished goods inventory 6,000. This one, add cost of goods manufactured that we calculated 1,70,000. This one, less ending finished goods inventory. Look, 9,000. So cost of goods sold is 1,67,000. Okay. So that's for today. We'll meet you soon with my next module, module 5. So today we learn periodic inventory system and perpetual inventory system, inventory planning, and here the formula of material, UQ, etc. ABC analysis, ABC, that means inventory control methods, and accounting treatment. So thank you today. Allah হাফেজ, টেক কেয়ার।